thanks everyone for joining for the January webinar of the NZGDA. The structure for today is we're going to have Leanne Ross, our Executive Director, giving a karakia to open and close the webinar. Then we'll be going over to Macmillan of PollenVC to give a presentation to provide value for New Zealand game developers about finance and growth, and there's a lot of valuable information that's going to be shared. After that, Chris Jagger from Alt Ventures is going to be giving a quick fireside chat with Martin to go into a bit more detail, and they can have a back and forth talking about whatever questions are on Chris's mind. And then after that, we'll have a quick Q&A. You can ask your questions via the Zoom chat, and I'll ask it on your behalf at the end of the call to Martin or Chris. Ask anything you like. There's no silly questions, no dumb questions. Then we'll have a closing karakia at the end. This is all being recorded, and this will be put onto our YouTube channel in a week or two, which you can find youtube.com/NZGDA. I believe if you want to find that and subscribe over there. All right, without further ado, thank you everyone for joining, and I'll pass it over to Leanne to give us an opening karakia.
Thank you, Carl. Kia ora koutou, everyone. We'll start today with the karakia just to bring us all together. It gives me great pleasure to introduce the first one of the year. Whakatakateo ki te uru, whakatakateo ki te tonga, kia mā kina kina ki uta, kia mā tara tara ki tai, he hi aki ana te atukura, he tio, he huka, he hohu, ti he mori ora. And welcome, Martin. We're very excited for what you're going to share with us all today.
Awesome. Thank you, Leanne. Really appreciate it. And yeah, over to you, Martin, for your presentation. Thank you.
Great. Thanks, Leanne. Thanks, Carl. And I just wanted a hilarious mistake on the very first deck of my slide that it's for me in London, it's still January the 11th. For you guys in New Zealand, it's January the 12th. So good old Eventbrite. So cool. So let me just, I'm going to flick through this, this presentation here. Hopefully everyone can see that okay. So I'm Martin Macmillan. I'm the founder of PollenVC. We're based in London and California. We have clients all over the world. So we, as a company, well, as a kind of like a mission, what we're trying to do here, the reason we do these sorts of webinars is to try to improve the financial literacy of mobile game developers and help them ultimately provide a set of tools and content to help them make smarter decisions about how they finance their companies. At the core of what we do is we provide credit facilities to studios who are looking to scale via paid user acquisition. And typically what happens is a lot of studios would just use venture capital to just raise more and more venture capital to put into scaling. And we developed this model back in 2014. We launched it in terms of providing sort of more capital efficient, non-dilutive capital to help achieve really efficient way to scale within mobile gaming studios. So I'm going to start off with just something that we've seen empirically true to be the case over the years. So when you have gaming studios, chasing greatness, if you like, and real success, yes, of course, there are a few viral successes, the Flappy Birds, Crossy Roads. Increasingly, that happens less and less. And it really comes down to using paid channels with a really, really strong focus on the numbers to achieve sort of scale and success. So we always, when we're working with studios, we always try and break it down into three really simple steps. So and we have this idea of the user acquisition machine. So first of all, and unfortunately where most people fall down is this concept of trying to establish whether they have a user acquisition machine. And by UA machine, I mean, can you put $1 into the machine and spit out more than $1 in lifetime value at the other end within some kind of known kind of framework with some certainty? So basically, when you spend money on ads, are you going to make money at the end of it, or are you going to lose money? And of course, if you can make money from that, then it's just, the shape of those unit economics can all be kind of modeled out financially. So if you put a dollar into user acquisition, you're making $1.10, 20, 50, $2, whatever it might be, great. If you're putting $1 into user acquisition and you're making 90 cents in lifetime value, then no amount of money is going to change that equation. So the first step is just the really sort of hard yards of like, do I have a machine? And if so, then the next question you'd say, well, how can I fund that machine? What are my different strategies? How can I do this using different kind of financing mechanics? And then thirdly, at some stage, what will happen is your machine will be running at full capacity. You won't be able to invest any more profitably into user acquisition because the unit economics just won't work anymore. And we're going to explore a few of the different scenarios as to how and when that could be the case. Sorry, going the wrong way. So do I have a UA machine? So we think about this as just a really, really simple investment equation. How much do I put in? How much do I get out, and over what time frame? So what we're trying to do is like disassociate ourselves a little bit just from the game and just be really, really dispassionate and look at the underlying unit economics behind the money we're spending on mobile advertising. So another way to think about it as a recipe. So you are trying to figure out your different acquisition channels, what each one of those is costing you, and then model different, first of all, when you break even on the ad spend, and then what the ultimate lifetime value of that user is going to be. And obviously you can't do this for individual users. You have to do it in cohorts of users. So you might say, I'm going to acquire 1,000 users, it's going to cost me $1,000. And when I model the behavior of those 1,000 users, I can see that, on average, they've paid me $2 in LTV. So I'm earning $2,000 of revenue, and that's going to take me 180 days, 360 days, whatever it might be. So you're trying to distill everything down to just this recipe. And then you want to be able to model it out in terms of so the first point that you really care about, and it's really important how quickly you break even. So certain genres of games will break even super quickly. So hyper casual games can break even day 1, day 3, day 5, day 7. Whereas you've got merge games, which might break even after 270 days, 360 days. And then you have social casino games, which may take even longer. It may take even longer than a year to get your money back. So the point of which you break even, then you're on dry land and everything thereafter is profit. So that's really important, first of all, to model out when you get to this 100% ROAS. And then from there, you want to model out the rest of the curve. So you say, okay, so I invest my dollar, I break even my dollar after, in this case, 120 days. And then after another, after I say 360 days, that's when I'm getting my $2 back out. This is really just an investment equation, $1 in, break even in 120 days, and I make another $1 of which is my profit after full 360 days. So think of that then as you could break that down. So if I've got a 100% profit and I want to think about that on a monthly basis, I'm making a return on capital of round about sort of 8.5% per month, and I can do that repeatedly over the year. And that's how I go from my $1 to $2. Now, in terms of modeling this stuff is fairly tricky to do. We, as Pollen, one of the things we have, and this is just up on our main website. So we have some tools that we probably don't have time to go through these things just now, but I would definitely urge people to go to our website at pollen.vc, and you'll see a suite of calculators. And the main calculator here, we've just got an image of it, but the whole thing is totally interactive and anyone can use it for free. It allows you to basically model out first of all, your retention curve, how long people are staying in your game, your acquisition costs in terms of there is CPI, the average revenue per daily active user, some of the sort of key metrics or the underlying metrics of mobile gaming. And then on the right, we're going to get a visualization of what your metrics are in terms of, when should you expect to break even if you do, and then what your own economics look like. So you can see an example here. So on the tools, what will happen is sorry, did that just come back? Something weird just happened on my laptop. You'll be able to visualize your own economics, and as you change the numbers and model and change around the different numbers, the graphs will redraw if you like to try and get a decent handle on your own metrics. So one of the things is when we're talking to people, it's like this idea of like I'm in my my technical launch, I'm in my soft launch, and then I'm basically getting my ducks in a row so that I feel that hopefully I've got to the point that the metrics line up and I'm in a position where I'm ready to scale. And a lot of the people we work with are sort of in their scale phase or thinking about their scale phase, trying to get their economics right. So we put together this sort of set of what we think of as pre-flight checks, the things you really have to be on top of and in place before you think, hey, now I'm going to start to commit lots of different, lots of capital into ad spend, and I'm going to have a period of time once I've acquired the users, and it's going to be a journey, and I hope I'm going to break even. So number one thing, you've got to have really clearly understood metrics to be able to build these models, use the test data from soft launch, use all the data you have, and to try and be kind of conservative about it. There's no point in trying to overshoot your LTV estimate and then ending up losing your entire ad budget because you mismodeled the numbers. So acquisition costs, the break evens, the LTVs, so number one thing you have to do. Two is make sure you've got a framework for how you're going to track all this. It could be something as simple as a Google Sheet. It could be some, fancy schmancy BI platform that you've developed internally. It doesn't really matter what it is. It's just got to work, and it's got to work for you. It's got to be right size for you. And then having an MMP wired in as well. So as possible as it is these days, you want to be able to try and attribute data and to get all these different sources that enable you to make sense of the metrics. And number three is a key one. We often see people go wrong here, where they may have, let's say 60 or 90 days of data, and they're trying to estimate what retention looks like, for 180 days or for 360 days or something. Now, unless you've got lots of data for that period of time, then you should always try and be more conservative in your estimates. So if you've got 90 days of data, use 90 days of data. But don't, you need to be really careful about if you've got 90 days of data, estimating what your D180 retention is or anything longer than that, because what you find is you can drastically skew your LTV estimates by effectively overshooting. So we'd always say be really conservative, and particularly in longer dated LTV estimates. And then last one, understand where you are, where you want to get to. So you might be spending, it might be $1,000 a day, and you want to get to $10,000 a day or $20,000 a day in spend. So try and figure out basically, understanding where you are, and then model out what you think is possible. I mean, the world's a big place, but there's a finite number of people and players that are interested in your game. So try and be realistic in terms of how much you can scale. The rule is if you've got a massively wide appeal like a hyper casual game, then you can have enormous scale, which is why these guys have got tens of millions of downloads. If you've got something that's more niche in genre, then there is only a certain real size of addressable market. So try and be sort of realistic in your estimates there. And then the last thing is when you're measuring, you're tracking your user acquisition spend, always look at it on a cohorted level. So try and figure out, these users, the ones I acquired on this day or this week, whatever, that are performing this well. We still see a lot of people that say, hey, roughly I'm spending $1,000 a day and I'm making $2,000 a day, which sounds great on the face of it, but you don't know when those users were actually, started delivering value. So it's a really kind of blunt instrument if you just look on sort of daily P&L versus ad spend. It's really important to understand where those users are coming from, what that original, what each one of these curves actually looks like, because again, the propensity to take your eye off the ball on your advertising spend can be huge. So next thing to consider, and this is getting a little bit deeper into thinking about how you're thinking about the financials and the financial planning here. So really important to understand the monetization payout schedules. So what I mean by that is each of the different platforms you're monetizing on. So there's going to be most likely two: in-app purchases and in-app advertising. And with in-app purchases, what happens is after the consumers are making the payment to Apple or to Google, it can be, with Google Play, it's up to 45 days. With Apple, with the App Store, it's up to 67 days before you'll actually see that cash. So it's really important to break the thinking between P&L, which is what you're making on a daily basis, and you can see those numbers racking up, versus when you actually get paid, because that's going to have a huge impact in terms of your ability to reinvest money back into acquisition. Now, on the mobile advertising side, it can be even worse. So you have a range of anything from net 15, which is basically 15 days from the end of the month. So the shortest paying ad network just now, I believe, is AppLovin, which is 15 days from the end of the month. But you also have a bunch of other ad networks like IronSource and Vungle and Unity, who will pay on a net 60 basis. That means 60 days from the end of the month. So that could be anything between 60 and 90 days after the ad impressions have actually been served up, will the developer get the money. So it's really important to factor these into your thinking and your financial models. And then exactly the same on the other side. If you are spending money on Facebook and Google and IronSource and TikTok and all of these different acquisition channels, after a period of time, they're likely to offer you a credit facility. And the reason they do that is they want you to keep spending on the platform. And the way it works is typically they'll say, hey, you no longer have to pay on a credit card or prepay. We'll give you credit terms, which means that, so let's say for all the ad spend you do in January up to your credit limit, we will bill you for that at the end of January, and you'll have to pay the bill at the end of February. So typically you'll get, that can be anything from 30 to 60 days free credit, which is great for the studio, because effectively what that is a risk transfer from you onto them of the ability to recover LTV. If the LTV doesn't come in, they've offered you the credit. Ultimately, it's unsecured trade credit. So again, it's really important to price these things in to your own models about your UA planning. So on one hand, and again, I'm not going to get too deep on here, but this is a mistake that people very often make. They're very focused on P&L. So you generally have user acquisition managers who are thinking, hey, I'm breaking even in 10 days or 20 or 30 or 50 days on my ad spend. But they're not thinking about when the bills actually have to be paid. So on one hand, let's say here you're spending up to 100K, and let's say you spend the money roughly at 20 days, you're up to 100K limit, you cap out your spend, but hey, by day 30 or day 40 in this case, I've made enough money in order to be profitable and pay off my ad spend. It's only when you overlay the actual the cash scenario, when are you being paid for those in-app purchases, when are you being paid for the ads, and you basically then you put that back 30, sometimes 60 days, that it opens up a real gap. So it means that even though you might be making the money back on your game, you physically won't have the cash to settle the bills. So that's just good old fashioned cash flow. So it's really important to separate the ideas of the concept of cash, when stuff has to be paid and when you will get paid, versus just the core economics of P&L. And then one thing here is to be cognizant of is the longer the LTV of the game, technically the longer the ROAS period and the LTV of the game, the greater external financing requirement you're going to have. Now, if I illustrate that through, let's say you've got two genres of games. You've got a hyper casual game. Hyper casual game is breaking even in 3 to 5 days on their ad spend. You can recycle that money around the track super quickly. So theoretically, you could spend $1 million in a month from a $50,000 budget if you were just recycling this money super quickly, if you have instant access to cash. Take, for example, a longer LTV game, like some of the merge games that we're seeing just now. They have a break-even period of roughly 9, 10, 11, 12 months, something of that order. So they're very confident in making that long-term LTV. Maybe people, a bit like a, successful match 3, like a Candy Crush. They may play these games for years to come, but in the meantime, it's going to take them a long time to break even. And therefore, if they want to keep spending, they're going to have to finance, more and more of that ad spend externally. So this is where you get into the financing conundrum around how you actually do it. So are you constrained by how much you've got in the bank? Or if you really believe in these metrics and you want to really go for it, then how are you going to fund it? Which brings me neatly on to how are you going to fund it? So again, this is the position now that we've figured out we're on top of these metrics, things are really working for us, and we have the ability to scale up without the economics getting disappearing effectively. So if you look at maybe sort of the 5 key methods of financing. So first of all, you've got VC investors, right? So investors who will put in a chunk of money for a share in your business, and typically most we're making a distinction here between funding user acquisition and then funding a studio. And very often what would happen was people wouldn't make that distinction and just say, hey, I need money, I go back to VC. So any form of alternative financing was very, very difficult in any technology market until really a few years ago. So typically most of these companies were going up and saying, hey, I'm going to raise more and more venture capital, and I'm going to dilute myself, and then I'm going to put the money into user acquisition, but hey, that's what I need to do to grow. So that's one. The second one is either factoring or revenue-based loans. So factoring is typically where people say, we'll give you a proportion of the revenue now, we'll charge you a fee, and then we'll take the rest of it when the platforms pay out. And that gives you slightly faster access to the money. Or increasingly, you see revenue-based loans, which is like a new breed of lender that's come into the market and say, we'll lend you money for user acquisition. We will take a cut of your revenues until we've been repaid with a fixed fee. So in the face of it, it sounds like, hey, there's some risk sharing here, but actually it doesn't work as well for gaming as it does for, say, a SaaS or an e-commerce basis, because the fundamental kind of timescales are a little bit misaligned. Now, this is very different in different countries, right? But the traditional, if you need money and you wanted to go and say, like, I don't want to raise venture capital, but I want to do this through debt instead, the traditional port of call would be to go to the banks. So in different countries around the world, the banks are more or less sophisticated, but generally pretty unsophisticated. So most of them don't really understand the digital economy. They're very paper-based. They are very, uber conservative, and they don't really understand the concepts of cohorting and LTV and cumulative LTVs and so on. It's kind of outside the normal wheelhouse. There is the venture debt product, which comes in, and very often alongside a VC round, particularly in the US, increasingly in the UK, companies would be able to borrow normally around 20% of the amount of equity they just raised as a sort of runway extension. And that was typically done on like a 3-4 year amortizing credit. So basically like a term loan that would be paid off just like a personal loan. Then you've got the publishers. So very often you see people saying, hey, I've got a great game, but I don't have the capital to get this to market and to scale it. So I'm basically going to trade a revenue share in my game, and sometimes, user acquisition expertise, monetization expertise. I'm going to go to someone to effectively front the game to market. And that may be okay. If you've got brilliant game making skills, but zero acquisition skills, zero monetization skills, whatever, going to a publisher is probably a really good route for you. But increasingly, we see people wanting to self-publish and create value. We did some analysis of public data from InvestGame some months ago, and basically we looked at all of the M&A data, and from beginning of 20 to middle of 21, and virtually I think it was 83% by volume of the M&A the transactions that were happening in the market were from self-published studios. 15% were publishers, and only 2% of people selling their studios were people that relied on a publisher to get their games to market. So it sends a really, really strong signal to studios who wanted ultimately to grow and be acquired, that it was very important to self-publish. And then lastly, non-bank revolving credit. So this is the kind of stuff that we do. And these are typically people who have a really deep understanding of the market, the economics, and the challenges that are facing the studios. And in the case of Pollen, what we've tried to do is we've tried to tailor our own financial product very closely to the needs of studios looking for capital to grow. So let me introduce you to what we call the capital stack. And this is just basically a multicolored diagram of common sense. What it's basically saying is once you've established what your user acquisition machine looks like, and you've figured out how you're going to fund it, then rationally what you would expect to do is to say, look, for as long as the well is open for drinking, I'm going to use the cheapest source of capital, and I'm going to work down different, potentially more expensive source of capital until it doesn't make sense anymore. So, and by not making sense anymore, I mean that the acquisition costs rise, the LTV is going to crest, and then it just the UA trade goes away. So first of all, the credit lines from ad networks. So if Facebook or Google or whoever is going to give you a credit line, always use it and keep it topped up the whole time. So always max it out, because it's effectively a risk transfer of you onto them. The next one is if you've got a bunch of free cash flow in the bank. So if you've got lots of free cash, maybe from an existing game. I'm not talking about lots of venture capital you just raised, because that has a different profile. But if you have an existing game that's throwing off thousands of dollars of free cash flow every month, and that cash is going to be sitting in the bank earning virtually zero in interest, well, you could take that capital and invest it at 8% a month or 20% a month or whatever your UA is returning. So that can, if you're in the fortunate position of having free cash flow, then that's your next best alternative. Sometimes people use credit cards, although it used to be much more popular a few years ago. We very seldom see it these days, because you would have people trying to game the interest-free period on an Amex card, paying down the Facebook bill or whatever it may be. Beyond that, you've got revolving credit facilities, and this is credit facilities that are secured. So effectively, like Pollen's business model is we look at the amount of money that's trapped, but basically all these receivables, the money that's been earned but not paid, and we also look at the money that's the value that's trapped in users you've already acquired but have yet to fully monetize, what we call residual cohorts. So we basically provide a line of credit against both of those things that you can borrow against. Below that, and again, it gets more expensive, you get into revenue-based loans. So this is where you have someone that will make a loan and will recover a fixed revenue share of your revenues every month until that's been required and until it's been repaid. Now, typically what happens is because there is less certainty to that than, let's say, your receivables, those loans get more expensive over time. So that's typically more expensive than any of the others. And then right at the bottom of the stack is venture capital funding. So if you've exhausted all these other routes as far as you can, and the user acquisition trade is still going, by all means, go raise more venture capital to put into it. But it should be like a really dispassionate decision tree where you keep going until basically it doesn't make sense anymore, and then you stop your user acquisition. You've reached your capacity, which we're going to talk about in a second. So one of the things we did as a company, we just put this out back in November, is we saw a lot of uncertainty, a lot of people getting confused by the different pricing models. Sometimes people would try and hide pricing structures in hidden fees, fixed fees, revenue shares, whatever you want to call it. And what we wanted to do here is just to give to write the guide to break down all the different business models and the pros and cons of each one, but also there's links in here to some calculators that will break everything down to an interest rate. So you can only compare different products and what's right for you when you've got an apples with apples comparison. So the point of doing this guide was to create that sort of comparison scenario. So this is available. It's just from the homepage on our website just now. It's a 28-page, reasonably technical, but for anyone who's kind of considering or looking at this and wants to dive into a lot more detail in it, hopefully it's a useful useful tool. And then the third part of the machine is then this is sort of like a back to school. This is like back to your first ever economics lesson, and it's this idea of like full capacity. When can I not put in any more money into user acquisition because it's not going to return me any money? And this is basically just like simple economic theory as well. So if you think of the idea of your demand and supply curves. So you've got a CPI curve and you've got an LTV curve. And basically what happens is, with your CPIs, the acquisition costs rise over time. So the more users, because it works in an auction system, the more users you're trying to buy, the more scarce they get, the more you have to pay for them. And the other side of that then is LTVs will fall as you scale. So if you think about it, so if you go for your real power users, people who just can't get enough of the sort of game you generate, they're going to be your highest spending users, and then you go out in concentric circles from there. So as I go from 1,000 to 2,000 to 5,000 users a day, I'm diluting myself in terms of people's propensity to pay. So ultimately, that will drag the overall LTVs down. Now, the problem is these are not, textbook, linear relationships. So these curves can be all over the place, and they're going to be changing every day. So what we always advocate is never take your eyes off the ball. Keep modeling the shape of these curves, and again, back to economic theory, your maximum profit is where those curves intersect, right? It's your marginal cost, your marginal revenue, and it's basically like saying, I'm going to keep buying users until it's no longer profitable to do so. That's what the intersection is. Now, the reality in freemium is that because you might have, LTV projections that might fall off track, most people in reality don't buy all the way into where their CAC equals their LTV. They say, I'm going to have a minimum hurdle return. Just in case they mismodel the numbers, they don't want to overshoot and then end up losing money. So they'll say, it's going to be an X% margin, and that's how I'm going to think about it. So it's really important to keep modeling this stuff over time in order to kind of really understand it. So final slide, I think, just some sort of takeaway piece of advice. So when you're hiring a finance lead, when you're putting in place, or maybe it's a head of finance or a CFO or whatever different stage you are, make sure you have someone who really understands the underlying nuts and bolts of the gaming business in terms of LTV modeling, curve modeling, all of those things. It's super important to have a close relationship between your user acquisition team and your finance team, because this is a shared problem. It's once the UA team has created the machine, it's the collective responsibility of the finance teams and the UA teams of how to get that machine to capacity. Think about capital efficiency. By capital efficiency, I mean using the right capital for the right purpose. So if it's like building a new game, an idea from scratch, absolutely raise it with venture capital. It's high risk, high reward. If you're doing this through, but if you're basically putting money into user acquisition cycles where you've got a 90% confidence interval of returning Y% in X days, use debt, and it's just going to mean it's less dilutive. So care about your dilution. Think about what share you're giving up to VCs who are investing, what they're investing on, and what risk they're taking, and make sure you don't. If you've got a really successful user acquisition, don't offer up a VC effectively an equity return, a high risk return for taking debt risk, low risk return. So just think about the different parts of the model. Use debt as part of the capital mix. This is about what instruments you're using for what functions. And then sometimes we've been able to see this recently. Instead of raising big mega rounds, of which half of it is going to get trapped up in a user acquisition cycle, you can potentially raise a smaller amount of venture capital, often at an improved valuation, and then use different other instruments to support it. So that was really it for me. If anyone's got any questions, you can reach out to me on email or LinkedIn or whatever makes sense. Hopefully that was slightly alternative way of looking at this, and gave you a few pointers. So I'm gonna shut up now and hand over back to Carl, and then I think we're going to do a talk with Chris.
Yeah, cool. Thank you, Martin. That was awesome. Definitely a good economics lesson for those that don't have economics experience like myself. Sweet. So I'll pass it over to Chris to lead this fireside chat. Take you know, 15 minutes. We're not on like a hard cut at midday, but after we'll see how the conversation goes naturally, but we'll do a quick Q&A afterwards with what questions are there. Over to you, Chris. Thank you.
Great, thanks, Carl. Martin, that was awesome. Thanks for the, there's a lot of content to cover, I guess, and I liked the, particularly, you know, the lessons around, you know, just really understanding user acquisition cost, LTV profiles, and then having that integration between user acquisition and finance to make sure that you're optimizing how you spend your money and where you're raising your money from. Couldn't agree more with sort of what you were saying. I guess there's a few things that quite keen to explore. So firstly, I guess the presentation was more aimed around mobile freemium games. So the first question for the sort of user acquisition debt financing, you know, what are the appropriate platforms? What are the appropriate sort of revenue models for the games? And is there any particular genre that this type of user acquisition financing is more suitable for?
Yeah, I mean, that's a great question, because obviously, like, if you're on like PC games and console game stuff, that the user acquisition mechanic is very different. So really, you know, here we're really focused on mobile games where you've got access to, you know, channels like Google and Facebook and so on, where anyone, it's very democratized, anyone at any level of scale can look to acquire users. And really you know, in terms of the majority of stuff we can see, basically, I mean, it can be across pretty much any genre of mobile games, and also really any mobile app as well. So we work with a lot with, you know, particularly at the moment, we've got a lot of health and fitness apps and, you know, mental well-being apps, and so on. The January effect is really big on that. But basically, anything where there is like a revenue stream on the app stores from either in-app advertising or in-app purchases, and then you've got an ability to acquire users and to track those users to whatever extent possible. Like in terms of genres, you know, short end, we do a lot of hyper casual games, but also like longer kind of mid-core games and so on. And increasingly, there's a desire for people to build games with longer kind of LTV. So you're building more of a franchise out of the sort of the hyper casual kind of rat run into longer genres.
And then what sort of scale does it become viable to use this sort of financing? Is there a minimum monthly revenue that you would tend to target where you think, okay, now it's worthwhile engaging with a revolving credit provider?
And so there's a level of scale at which the economics don't really work. We want to keep that level as accessible as possible, which is around, you know, something around sort of $20,000 to $25,000 a month in revenue. But that said, the most important thing is the underlying metrics and whether they're scalable. And so we've made exceptions in the past where people have like had insane metrics, and you know, then it's just a question of putting money around the track. So we have a customer right now based in Asia who we started with. It was very marginal whether it was kind of worth it. It was around about 25K, and in a little bit less than 2 years, they've just gone through $2 million a month in revenue. So you know, and for us, it's super satisfying when you can help people from a relatively small starting point get up into into much greater echelons without having to go and raise. You know, I'm not saying not raise venture money, right? This is very often a complement to raising venture money, but it's an efficient way to do it, and it keeps founders with more control.
And are you finding it's harder to get confidence around the user acquisition machine, the metrics, given, for example, Apple's changes to the IDFA privacy rules? Has that changed the model at all?
It definitely has. What's happening is I think people got very kind of used to this idea of like a not quite perfect, but pretty perfect attribution world. So you can kind of function on autopilot a little bit and, flying by rails, whatever. And then what's happened is, towards the end of last year, people had to get a little bit more back to basics, get a bit more creative, look for different channels, look for different signals. Some of the kind of machine learning platforms that are trying to solve the problem in a privacy-centric way. I mean, I think you can pretty much assume the problem will get solved. There's a bit of a reset and a rebasing of the landscape, but there are some very smart people out there, and we're not going to go back to TV ads and billboards anytime soon. So it definitely set the market off. The thing that is, and again, this is just down to confidence and metrics and underlying products and how the team functions, stuff like, if you're in hyper casual where you've got something really short, then you're gonna find out these outcomes a lot quicker. If you've got something where it takes you like 9 months or a year to break even, you've got to be really, really sure of those metrics before you start to really, really double down and invest a lot of capital. Because the longer the LTV, or the longer the period to ROAS recovery, you could burn a lot of investor money if you get the numbers wrong. So it's really important to have a strong UA and kind of BI function.
So what would your advice be to a studio that maybe is targeting a longer LTV model, but they're early in the starting gates? What sort of evidence points would you want them to prove out so that you could get confidence, and or any revolver provider could get confidence in the model?
Look at the soft launch metrics. So people will generally know, right? I think people are pretty sanguine these days about saying, hey, these are my metrics, and provided these hold or they don't go above this level, and provided we can scale, then it kind of works. The problem that we've seen in the past is where people kind of like start to put the foot on the gas and the foot just goes through the floor. So what happens is you're spending 1,000 a day and you think, great, I'm going to take this to the moon. And then as soon as you start to spend 2,000 or 3,000 a day, the economics just blow up and you just can't do it. So to be honest, it's really, really hard to estimate that stuff. So you have to look at, the comparables. You have to try and get as many data points as you can to do that. But, once you're there, and again, for us, the risks are, risk profile is different, right? So all we're doing is, in a way, if you've done $1,000 in sales and we're lending you $1,000 tomorrow, then our primary bet is basically taking credit risk on Apple or Google or Facebook, whatever. But the value of having that money and being able to reinvest it, if you're going to be able to do it profitably, it is huge. The goal is the cost of the interest should be a rounding error compared to the amount you're able to make from the ad spend. And if it's too close, you shouldn't do it. But it's different. Everyone's metrics are different, and it's really a case of having a degree of confidence in there to say, right, okay, now we want to go from 10,000 a day to 50,000 a day. How are we going to finance that? And then what options are available to us?
Yep. And I guess a final one from me, and then I guess we'll throw it open to sort of some of the questions via Carl. So how popular have you seen, what's the growth in studios wanting to use this sort of financing method? I mean, you've been around for a few years now. How have you seen that profile change over time? Yeah,
so that's interesting. So it's really, so fortunately for us, this is starting to become a lot more kind of mainstream now over the last couple of years. In the very early days, it was incredibly difficult to get the messaging across, which is why we put so much effort into the kind of the education piece and helping people sort of onion out the problem and discover it. The very quick background to our business was I'd spent 2 years of my life doing a music remixing app, and then when we launched it, I came across the exact problem that we had, that we now solve. And talking to most financial services guys in the UK back in 2013, no one had a clue what we were talking about. So the old world of finance was really not set up for a digital economy. Now, I had a previous background in banking, so I was able to kind of like join the dots between old world and new world. But for the first few years, it was really, really difficult. And most people were just like, hey, if I need money, I go back and raise more money from my VCs. So we had, it took us a long time to get the sort of the product market fit right. Now, what's happened over the last couple of years, people have started to get a lot wiser. We've had some tremendous case studies. Other people have come into the market and so on with different models and so on. It's much more of a thing now. And, I think that's a good thing that, when you have more people enter a market, they do so because there's an opportunity. So we still really believe a lot in the education piece, and that fundamentally you've got to make sure people understand what they're doing and why. This isn't something you sell. This is something people kind of discover, and they warm themselves to it. But yeah, fortunately for us, in the last sort of particularly in the last 18 months or so, we've seen a huge kind of uptick in our own kind of volumes with just much greater acceptance.
Fantastic. Hey, thanks for the presentation. That was super informative. Carl, over to you, I guess, for audience questions.
Yeah, thanks, Chris. Thanks, Martin. I loved the dashboard that you showed on the PollenVC website. That's really valuable to have just for people to tinker around and see things. So I love organizations that do that provide, you know, free tools just to provide more context, especially when it comes to numbers and money. It's always handy. Yeah, so just going through, you did kind of ask this, Chris, but Anna Barham asked, is this relevant to premium PC games? We're not in mobile at all and use very little paid marketing. So I guess, Martin, is there any advice that you would give to any New Zealand game developers that their primary platform is PC and, you know, using Steam and Epic Games as platforms?
I mean, the core of the offering is it's just basically a revolving credit facility that provides more working capital to the studio. Now, it happens to be that the primary use case in mobile is people want to use this because they want to reinvest back into UA, because it's like a closed loop. Now, the reality of it is we fund a bunch of other people, and including in the VR space, you know, and actually some of the PC, but the console providers have terrible payment terms, and the studios are really, you know, sometimes you'd be waiting 90 to 120 days to get paid. So people like to have these facilities just like regular working capital facilities that they can draw against. So we, for example, fund a bunch of different creator platforms who effectively pay the creators out before they are themselves paid, and that just gives them an increasing sort of amount of money they have to fund off their own balance sheets to do that. So that is much more of a kind of regular working capital situation. So anyone on, you know, PC, console games, the concepts are just exactly the same to provide extra working capital to the business. It just the idea of the use case for, you know, user acquisition kind of is less relevant, because the whole mechanic for UA on those channels is different.
Totally. Yeah, the whole just explosion of microtransactions and how big that has played a factor in the overall games industry, you know, revenue on an annual basis is huge, and it's a model that I think a lot of other mediums and industries are adopting as well. That games have done a great job at refining over the last decade. Next question from Greg Quinn is, what are the recommended platforms, social networks to use your UA spend on for indies?
Great question, and I don't have a particularly comprehensive answer, right? Because what happens is, like, the different, it's very sort of like specific to, you know, what works for your, you know, for your game, right? So most of the bigger guys have done a good job of having self-service platforms where people can, you know, people can access via, you know, relatively small volumes as they're testing things without having to have minimum spends and account managers and so on. So the market generally has got better at doing that. But the reality is, like, what we always say is, like, don't just go with one, right? You have to test different channels, small budgets, and on, you know, different channels, and, you know, use some common sense, right? So if you've got something that's very kind of like, you know, kid focused or teenager focused, whatever, then, you know, obviously platforms like Snap and TikTok and so on are going to be where those audiences live. So think about where the audiences live and where you think the best platforms are, and use that. Now, on one hand, don't just use one and be like, oh, I'm just going to use blah channel and, you know, just stick with that. But the other hand, you can't spread yourself too thin and say, well, I'm going to spend $20 a day on 20 different channels, because you'd spend your life logging into these different platforms. So there's probably, you know, it's probably a spread of like, you know, 3 or 4 that you might want to use, and see what's working. And if something's not working, not performing, drop it and try what you think the next best thing is, and keep an eye on the forums and what people are saying, because it's definitely shifting sands. It's not a set and forget type of arrangement.
Totally. I just a follow-up question from that. If someone was putting, say, $100 on Twitter every month for advertising, how long would you say is like a minimum amount of time for them to invest before they make a decision on if the platform is valuable to them or not?
I mean, I don't think it's a month. I think you probably want to spend, you know, I mean, it could be like we've seen people do like $100 in a week or whatever, and then you know, hopefully fairly quickly you're going to get an idea And again, it depends. It all depends on the genre. If you leave something for too long and you don't change the creatives and you don't change the audiences, it's gonna tail off anyway. So I think probably like doing doing 1 to 2 week sort of sprints and being really on top of it. But I'm being on top of it every day, right? This is something you have to be on top of every day. But if something's not working after a couple of weeks, or the economics just don't work, then that's probably your time frame to sort of chop it into to look at something else.
Mm. Yeah, Matt Brady asked if New Zealand government provide any funding, and that's something that I could probably answer. The NZGDA are lobbying to get some tax incentives for New Zealand studios. Australia last year have announced that they're going to be offering some quite great incentives that that we're trying to lobby to get something that's on pass so that we don't lose too much talent to Australia. Other than that, though, there are some grants that some government bodies offer, like the Ministry of Culture and Heritage, the New Zealand Film Commission. They have some like grants and funds that that you can pitch to, that they do accept on the occasion game related projects, but there is a lot more that we can do in New Zealand for sure. Next question. I think that might have been it. Yeah, that was it. So it's right on 12 on the dot as well. So I'm going to, big thank you, Chris and Martin. I'm going to pass it over to Leanne to do a closing karakia for us. And yeah, thank you so much for your time, Martin, and Chris, for your insightful questions. If you want to watch this, you can watch it on our YouTube channel over the next couple of weeks. And the link will be in the chat if you're interested. Over to you, Leanne.
Okay, we'll send you off into the rest of your day, everyone, and we hope it's great for you. Unahia, unahia, unahia ki te uru tapanui, kia wātia, kia mama, te nākau, te tinana, te wairua i te ara takata. Koira I rongo, whakauria ake ki runga, kia tina, tina, huie, tākie. Have a great day.
Thanks, Leanne. Take care, everyone. See you next month for the
Thanks,
next webinar.
everyone.
Thank you.
Thanks, guys.